One of the most frustrating things as a trader, whether you've been in trading for some time or whether you're new to trading, is feeling like you're behind the market and you don't understand the higher time frame intention of price. Because what that leads to is essentially bad habits in the market, whereby you feel like you have a read, you're wrong on that read, you're placing trades that are getting stopped out, you're chasing price. It just leads to bad behaviors that accelerate your curve of unprofitability in the markets. Um, Maybe you are mapping market structure in traditional ways. Maybe you're using traditional supply and demand or moving averages, whatever it might be. If that's not working for you, it's probably because you don't have a strong read on the intention of price based on higher time frame candles. So what I'm going to do today is introduce CRT, candle range theory. And this honestly changed my trading completely. And I'm hoping that it's going to give you a much stronger context around your trading that's going to do the same for you. We're looking at GBP USD. Right now, we could use a whole host of techniques to map this structure and find ways that we think make sense to trade it. But honestly, I don't think you can without understanding higher time frame context through the lens of CRT. So we're going to spend a little bit of theory first, going through what CRT is, the concepts behind CRT, and then we're going to come back here and make sense of this price action through the lens of CRT. So let's get started. What is CRT? Candle range theory. So the principle of CRT, as I'm going to sort of allude to, is every candle that you see on your candlestick charts is a range of price action that can be traded. So I'm going to go into that in more detail, but if you think about it, any future candle ranges can be anticipated based on analyzing previous candle ranges. Now, when we're talking about candle ranges, we're talking about specific candles. So the whole premise of CRT is that we are going to analyze a higher time frame candles to anticipate what is going to happen next in the market based on how those higher time frame candles close. And the whole premise of price or price action is that it is fractal. So what happens on one time frame happens exactly the same on another time frame. Price is, it just happens. The time frames that you're analyzing that price are looking at the exact same price action, but just over different periods. So the trick to trading is combining those time frames into stories that make sense. I'm going to do this from a swing trading perspective. So I'm looking at trading monthly, 2-weekly, weekly candles. But equally, if you want to do this for weekly, daily, or 2-day candles, or even 4-hour candles, it's possible. It works in the same way. So for now, just think about the relationship between candles and the way that these time frames tie together, rather than is this a swing trade or a day trade. There are benefits to swing trading versus day trading that we'll cover later on. For me, I'm swing trading, so that's what we're going to look at today, but this applies just as well to lower time frames. So before we look at this CRT visualized, I just want to talk about what it actually means when we say every candle is a range. So if I just create here very quickly a candle that we can analyze. So we have, apologies for the colors, this can be a bullish or bearish candle, it doesn't matter. What we have here is the high of the candle. So this is the highest point in this candle's range that price traded. Then we have the lowest point that price traded, so the candle's low. This seems fairly obvious for now, but let's just take the time to go through it. So the low of the candle, the high of the candle, then we have the body of the candle. So if this was a bullish candle, this would be the opening price of the candle. So price most likely traded down, traded up, and closed. And where it closed is the high of the body of the candle. If this was a bearish candle, then price would have opened right here, traded down, and the close of the candle would be right here. So if we now have another candle printing next to it, as soon as, for example, if this is a weekly candle, this weekly candle closes, a new candle starts to print right next to it. So this is very obvious. And what can that candle do? It can trade through and close. It can trade below and close, or it can do this and break out. So there's only really a couple of things that a candle can actually do in the life cycle of its journey. And what we're looking to do is read how this candle closed, probably in relation to previous candles that printed here, to understand, using lower time frame price action, what we think is going to happen. Do we think the price is going to respect structure and trade lower? In which case we can place trades to that effect. Or do we think that price is going to liquidate the low of the candle and maybe shift and target either the midpoint of the range, the 50%, the candle's opening price if this was a bearish candle, or ultimately do we think that it's going to target the liquidity that sits at the high of this candle? So that is the premise of trading candles as ranges. Now we're looking at the 12-hour chart right here. So if we were to be taking this type of view, maybe we would want to trade the monthly, the 2-weekly, the weekly, or even higher time frame candles to get a determination of what we think is going to happen on this time frame, based on the fact that any future price action is a new higher time frame candle printing and reacting to previous higher time frame candles that have already printed. So this is going to get a lot more clear, but just try and get your head around that. When you're marking things like market structure or looking at resistance levels, it's, yes, these things do play out. They do get respected to an extent, but really all price is, and all that you're analyzing on this particular time frame, is a visualization of higher time frame candles being printed. And those are going to be printed based on how candles before them have closed. So that's what candle range theory is. And definitely I would urge you to stick with me here, because now we're going to get into some theory of what actually happens, what tends to happen with candles, especially in certain instances. So this is the bread and butter of CRT and how you would visualize it. So what we tend to see is that you have accumulation candles. An accumulation candle, again, could be any candle that is moving up or down, that creates a range in the market. So in isolation, they mean nothing. But just assume you have candle one or we're going to say this is a bullish candle that traded up and closed. In the instance that we get this type of activity, price trading the candle, the next candle in the sequence, trading up above the candle's high and then closing down. Once we get that type of price action and we get a close whereby the second candle liquidated the first candle's high and then closed, here you can see it doesn't matter if it's a bullish or bearish candle, it closed inside this candle's range, we can basically say that candle 2, I'll make this a different color, liquidated the high of candle 1. It manipulated above candle 1. So what are we now anticipating to happen next? Well, price could do this, find some new support and break out. And that can and does happen. But the more likely thing that happens is that price tried to go higher. but it ran out of steam, it ran out of fuel or demand, whatever you want to call it. So it's going to seek liquidity lower. So it's going to do this. And it might trade back and find support somewhere lower in this candle. But what often happens is that it seeks the liquidity at the low of candle 1. So what you get is this type of action where you have a candle that candle 1, candle 2 manipulates above the high, and then candle 3 accelerates to seek liquidity at the low of candle 1. And this is basically what you're seeing on your charts across all time frames, and this is candle range theory. So in terms of how I trade, I use this all the time, but I will also use other concepts. Like, for example, if this candle 2 had closed above candle 1, then it would be breaking out of candle 1's range. It would have had adequate supply or demand, whatever you want to call it, to drive price higher. So I might then be looking at structure within this candle to trade in that same direction. But we're going to focus on this type of CRT for this video, whereby you get a purge or a manipulation above candle 1's high, and then we're looking to basically take reversal trades to target the low of candle 1. That is CRT from a basic perspective. Now then you have additional concepts. You've got the entirety of this range and the actual premium discount zones that sit in this range. And that's something we'll talk about later. And then you want to understand, as additional confluence, where are we actually reacting from a higher time frame perspective. So you have this level here, which we're calling a key level. So maybe this is a higher time frame fair value gap, order block, breaker block, swing point. It's some point of higher time frame liquidity that was seeked that also could become a catalyst to actually drive this reversal. And if we just talk quickly about why this works, price is always seeking liquidity. Liquidity drives every large Forex financial market out there. Price is seeking liquidity in the market. And candlesticks are a visualization of supply and demand. So if we take this candle 2 and we just think about, not about candlesticks, but just about what is happening. Price is trading up at this point. Let's assume this is a bullish candle. Don't worry about bullish bearish right now. We just had a candle that printed, and let's assume that price is trading up. Why is price trading up? There's an imbalance between supply and demand. There is more demand in the market that is causing higher prices. However, once we get to this key level, maybe this key level of liquidity above this high, the fact that this candle closes inside this candle's range indicates that the demand that was driving these higher prices ran out of steam, or that new supply stepped into the market which outweighed or overthrew the demand that was driving those higher prices. So if then at the start of candle 3 we're seeing on the price, on the lower time frames that we're analyzing, this sustained lack of demand, then the next thing that price needs to do is seek new liquidity. And so the most logical place that it's going to do this is at old lows. And this tends to be candle 1, the low that price will seek quickly to rebalance, to find new liquidity, to seek new demand that could either drive price higher, or if that demand doesn't exist, continue this downtrend whereby supply remains in control. So very sort of core foundational concepts right now, but what we need to just understand is you have accumulation candle, candle 1. If you get this type of candle as a second candle, this we're going to call a manipulation candle, and then we're looking at distribution. And this is where orders are distributed back down to candle 1's low. So we've covered why it works from a foundational CRT concept. And we can get into a lot of detail on candle range theory, but this is just for today, the basics video, what I want to cover. Higher time frame candles tell you the story that you are going to use to take lower time frame trades. So our job as candle range traders is to identify the story on the higher time frame using confirm close candles, read higher time frame candles through the lens of CRT, and then fundamentally it's about executing on the lower time frames. So we can then use probably all the things that you're already using, things like structure shifts, internal range liquidity, to plot entry points and exit points using those higher time frame candles as the fuel that's going to get us there, and to actually target levels in the market that make sense. So this is going to give you everything you need to execute, whether you're doing day trading or swing trading, profitable positions and trades in the market. So we're going to talk about swing trading, but remember, price is fractal. This just applies across all time frames, whether you want to day trade, swing trade, position trade. But we're going to look at the 12-hour and the monthly candle just as a very introductory way to visualize CRT. And we're going to start with GBP USD. So let's try and make sense of this price action for a second. We could look at highs and lows in the market. So maybe we're saying this high got taken out. So this is a strong low or an area of support in the market because we had this. So when we're coming down into this level, what happens? It just gets disrespected. And then we're saying, okay, well, this was the last break right here. So maybe this is a high that we want to trade to go lower. Price just blitzes it, breaks straight through. And this just happens time and time again. You get some structure that gets respected, you get some structure that doesn't get respected, and you can spend so much time looking at trend lines or support and resistance zones or whatever it might be, and it works until it doesn't work, and then it's just frustrating. What we can do instead is map higher time frame candles. So what I'm going to do is just put this candle indicator over the top of our chart, and this will change everything for you. So we have essentially the 1 month candle behind the 12-hour 12-hour price action. So I'm going to show you just two very clean visual ways, two ways that CRT just played out perfectly looking at GBP USD. So first and foremost, we can see that during the month between July and September, we had this bullish candle right here. So price, this was the lowest point right here that the candle traded. This was the opening price of the candle. And then this was the closing price, and this was the high. And what happened in the next candle? We saw price trade higher first, above the previous candle high, and then close inside the candle's range. So if we just look at this entire range of price action right here, you're probably already seeing what happened. We had bullish price action. Actually, sorry. We started off with bearish price action, and we had some sort of structure shift here. We manipulated above this high, or seek the liquidity here. Price ran out of steam, shifted, and then price closed. And then what does candle 3 do? So we just stop here. This candle manipulated above candle 1. So we had accumulation, manipulation, and then what happens? Distribution. So from a higher time frame perspective, we now have a very clear read on what price wants to do. And then if we just fast forward, we get this down candle right here, bearish candle. This candle's job was to seek liquidity at this low. Then candle 2 trades straight away below its low, comes back into this area of support, tries to go lower again, runs out of steam, shift. And what does it then do? So we just stop that again just to make this explicitly clear. This is the high and low of the candle right here. This is the entire candle's range for the month of November to December. We had price raid the liquidity below this accumulation candle, manipulate, and then ultimately we do this and quickly target the liquidity that sits above this high. So we've now looked at what happens between September the 1st and January the 1st, and we have two very predictable moves in the market that played out through the lens of CRT perfectly. So coming back here, just to make this explicitly clear, we have accumulation candle, manipulation, distribution. And we have this perfectly playing out here on GBP USD. Accumulation, manipulation, distribution. Accumulation, manipulation, distribution. So that is what constitutes our higher time frame bias. And what we have in addition to this, because we want more accuracy, is the ability to overlay additional clarity or granularity. So if I just take away the monthly candle for a second, we then overlay another candle, which is our weekly candle. And this can also be a 2-weekly candle as well. So you can play with this. And I do that. But we're just going to look at the weekly candle. Now, what do we have on this specific lower time frame? So if we look at the monthly time frame and we know that we're digging below this monthly low, this level in the market at this particular point, then we see something on our mid time frame that gives us a greater confluence or understanding of what price is trying to do that we can trade. So what can we look for to do that? So I'm just going to take the monthly candle away for a second and just focus on the weekly candle. So here we have a candle, a weekly candle, and we're still looking at the 12-hour. You could go lower than this. You want to look at the 4-hour, whatever it might be. We had a weekly candle that closed right there. Then we have the next candle that trades below that candle's range. And it closes at this point right here. In doing that, what has it now done? I'll make this a separate color. It has closed inside its previous candle's range. It's liquidated this low. So now we have two stories playing out. The first is that we have a candle 2 digging below a previous candle's low. Then we have a weekly candle digging below its previous weekly candle's range and closing inside. And this is fast forwarding somewhat. But what do we then get? So we have bearish price action. Price trades into, I'm going to make this quite big so we can really examine what's going on here. We have a 12-hour order block right here. Then we have a 12-hour fair value gap right here. I'm just going to make this something that we can actually see. So we have this bearish structure at this particular point. And then what price does is it tries to go lower. It comes back, tries to go lower, and then trades through. So it disrespects this liquidity right here. And in doing that, it creates new bullish order blocks. So again, I'm just going to mark this as a 12-hour order block. And I'm going to just take the weekly away for a second so that we can visualize this. So we had bearish price action into a fair value gap, which we're going to say is our internal range liquidity. And just look how price is leaving these weak highs here. There's no like liquidity swept before this low. It's just a sort of drift of price down. We get trade back into our support, try to go lower. We touch again, we try to go lower. In doing that, new demand is stepping into the market. We then get a candle close above, again, a new order block right here. So we're getting demand stepping into the market. And eventually, then price breaks out. And what does it do? If we bring this back, it seeks the liquidity above this high. So on this lower time frame, we've just seen the exact same thing play out. We've seen candle 1, weekly accumulation, candle 2 digging below the low and closing inside the range, and then candle 3 accelerating aggressively to the high of the range. So if you're on the 4-hour time frame, I mentioned price is fractal, you probably could have traded this for 3R maybe, whatever it might be. But we are also keeping in mind the fact that, look at this, there's no strong highs, there's no like those jagged sort of sweeps of liquidity that you'd expect to see here. You've just got weak price action all the way down. And we have this monthly candle digging below this low. So from a swing perspective, yes, we can take a short-term position to play this. So we could take this 12-hour order block, cover the lows, and target the high of the candle, and you've got a 2R. But why would we want to do that if we can play this wider move, which is back to the high of this accumulation candle, and that would be a 7R. Now, we can debate whether you would actually want to do that or whether you want to just trade the structure that then gets us to this high, because this is something altogether different that we'll talk about in other videos. But you know, there's ways that you could just use the same logic, the exact same logic, to take positions, and I'm just mapping this very roughly in the market where price is making this journey. But this is the basics of CRT, and you can see right here, I didn't have to do tons of marking up. I can just use logic. I can use logic which is derived through understanding these higher time frame candles, the way they print, and the relationship with midterm candles that sit within these candle ranges. Maybe it's the weekly, the 2 weekly, daily. I probably wouldn't go to the daily if I was swing trading this type of chart, but you can use these things in combination to pick very high probability trades and have a very strong understanding of where price wants to go. Because again, if we just come back to the mechanics of supply and demand, all that's happening here is that we have supply and control. There is more supply in the market, prices are heading lower. Then that starts to shift, it starts to phase out. Some of this is manipulation. Price is seeking liquidity below that low, as we just discussed, before it's going to actually make its journey back. So if you're using this order block, it's not necessarily going to play out because price wants to seek that liquidity first. But ultimately, any supply that was trying to drive lower prices, again, fizzles out. And then it gets quite fast, to be honest, because if there's no supply stepping in here to drive lower prices, then it's probably going to be that the next strong area of supply sits up here. And so price just has very little resistance to run its way back. And that is the concept of CRT. I just want to show you one more example of this, a bearish example very quickly. And this is looking at Euro GBP. And we just see the exact same thing playing out. This is the price action for September to, from October till September, till November. So you've got this entire range being the monthly candle range. you've got the close of the bullish candle right here, you've got the opening price right here, you've got the candles high, and then you've got the candles low. So they're the different points of liquidity that sit within that candle range. And then what happens? You have price starts a new candle based on closing above this previous candle. So even though we've seen the structure shift, this was a bullish candle, so we're still expecting higher prices. Eventually this area gets respected, and then we trade above, and then we try and go higher. Demand is still trying to stay in control, and then we get shift, and then eventually we get a close of this candle. We create a top wick in this new candle, and in this particular instance we don't get this fast move in candle 3. It takes an additional candle, but ultimately price heads to the low of the accumulation candle. So you've got candle 1, candle 2, manipulating the high of this candle right here. It closes, and then price makes its way to the low of candle 1, and that's a bearish example. And we could point to multiple CRTs in here from a weekly, 2-weekly perspective that were tradable. But I'm just talking today about the basics of CRT and what it is. So candle 1, accumulation, candle 2, manipulation, closing inside the range, candle 3 is targeting candle 1's range low. Then from there, there's a lot that we need to understand. Internal range liquidity, external range liquidity, where to get in and out of trades, when to get in and out of trades, risk to reward, our entire trading strategy from a execution standpoint. Why these fail? Because this looks great, but they do also fail. And what are the reasons for that? Because we're looking at the monthly, but what about the 3-month, the 6-month, the 12-month? So just because you get a close, it doesn't necessarily mean that this is going to play out, because there might be higher forces at play. But from a foundational perspective, we have enough here to understand a lot more than most traders know about price and how price actually works. We are going to dive into much more detail in future videos. And I also urge you to check out other videos that I've put out that look at things like multi-time frame analysis, true market structure, supply and demand, points of liquidity like order blocks, breaker blocks, fair value gaps. What I'm trying to do is piece together a library of information that you can use to become a better trader. And that's what I'm going to be focusing on for the time ahead. So hopefully this was valuable, and thanks for sticking with it, and we'll see you on the next one.